Time and again we highlighted that our favorite NBFC pick MAS Financial is worthy of a serious look when the mood is tentative and the stock lackluster. The December quarter result aptly brings out the strength of this company as asset quality remains nearly pristine despite successive waves of COVID-19 and the more conservative NPA recognition circular of the central bank. Thanks to the strong balance sheet and return of normalcy, MAS is embarking on growth and beefing up its distribution. However, as has been the DNA of this company, growth will be calibrated without losing sight of asset quality. The stock, if you look at it, has reacted sharply. It's up almost 40% in the last few trading sessions. It is pertinent to point out, nevertheless, that this comes after a huge underperformance of 25% growth since March 2020 COVID lows to date, as against 130% rally in the Nifty over the same period. Moreover, in the context of its growth outlook, valuation is at historic lows. Therefore, we see sustained re-rating and recommend MAS as a high-quality addition in the portfolio. MAS Financial is a small NBFC with a presence across 7 states and primarily focuses on 4 product categories: micro-enterprise loans, SMEs, two-wheeler and CV loans. The company also has a housing finance subsidiary catering to affordable housing segment. MAS has weathered the pandemic well, except for some trouble with one of its NBFC partners in the second quarter of FY22 that has been fully provided for. Despite the more stringent NPA recognition and upgrade norms, gross and net NPAs have remained stable. With collection efficiency reaching 97.5% in the December quarter and the third wave of COVID having minimal impact on economic activity so far, we feel MAS has crossed the toxic asset hump and can now focus on growing its business. MAS has a unique distribution model of revenue sharing with NBFCs that source close to 55% of total assets. This model provides better last-mile connectivity and underwriting as operational and credit costs are shared. However, the next leg of growth is going to be fueled by its own distribution as well, which is being ramped up as reflected in the spike in the cost-to-income ratio to 30% from 19% in FY21. MAS has tied up with 2 public sector banks, Bank of India and Bank of Maharashtra, for co-lending and has forged tie-ups with multiple fintechs to expand its reach. Albeit the decision to grow, the management will have adequate risk sharing to ensure underwriting standards are not compromised in the process. The company had gone extremely slow on disbursement in the wake of COVID-19. Disbursements started picking up from the second quarter last fiscal and accelerated in Q4 but again degrew in Q1 this fiscal year. However, growth has revived steadily and now the company sounds confident of growing the book by at least 20 to 25% in the coming years, while the endeavor would be to push growth to 25 to 30%. Despite a possible rise in interest rate that normally puts any NBFC at a disadvantage, we see MAS coming out winning thanks to its diversified source of funding and healthy capital position. It has a capital adequacy ratio of 27.4%. Given its reach and underwriting skills and its target market that is largely underserved, we see little risk to this high ROA business if economic environment remains stable. MAS has a housing finance subsidiary focused on affordable housing. It sees housing as a key growth driver but was cautious on lending so far. The book grew by 2% sequentially to 307 crores in the last quarter. However, the balance sheet has been well protected. Gross and net stage 3 assets were 0.69% and 0.49% of AUM. The company's restructured book was 0.85% of the AUM and it carries a buffer provision to the tune of 1.15%. The company has very high level of capitalization. It has capital adequacy of 51% and could accelerate growth as the economy improves. Now, we project strong earnings growth of 26% over FY22 to FY24 for MAS Financial. While the IPO price was 459 rupees and the stock was listed at 660 rupees, which is similar to the current market price, the present valuation of 2.1x of FY23 estimated book is at a steep discount to the listing valuation of 4x forward book as well as IPO valuation of 2.8x forward book. Now, we see immense headroom for re-rating and advise investors to include MAS as a high-quality core portfolio holding. Of course, a key risk to watch out for will be severe economic impact due to COVID-19.